How's it going? Jake here with MogulTool. Thanks for tuning in. So today we're going to talk about the relationship between the NOI and cap rate value of a property. So if you don't know already, the difference between residential real estate and commercial real estate, one of the main differences is that residential real estate is priced in accordance with the market, whereas commercial real estate is going to take into consideration the amount of cash that it produces. So the way that measure is kind of included into the valuation is through something called a cap rate. Now, you've probably heard that a cap rate is the amount of, it'd be the percentage return that you could expect to receive on a property if you were to purchase that property for that price in cash. So, for example, if you were to buy a property for $1 million, then a 6 cap would be making $60,000 a year in income. So that NOI of the property would be $60,000. That would be a quick example of it. Now, a different way of looking at it, and what we'll do today, is kind of talk about some of the different ways that brokers and sellers will kind of cleverly use different cap rates to justify higher prices and kind of what to look out for. So what this is just it's a quick snapshot from an offering memorandum that I was looking at. This one includes the purchase price. It doesn't always include the purchase price, as well as two different cap rates, which they almost never include two cap rates. In this case, we have a current cap rate as well as a fully renovated cap rate. And as you notice, the current cap rate is lower. Now, if you don't already know the relationship between cap rates and values, if a cap rate is higher, then the value of the property is lower. So a 10 cap property let's look at it like this. A $1 million property in, let's say, Cleveland is probably, let's say, an 8 cap, whereas a $1 million property in California might only be a 3 cap. So a lower cap rate equals a higher valuation of the property, and it works in both directions. So let's clear that up a little bit. So in this case, what they're saying is that based off of the current operations of the property, the cap rate that you'd be purchasing at based off the NOI that's currently in place, it would be a 5 cap, 5.03 cap. The cap rate based off of the fully renovated numbers, so the broker's pro forma numbers, would only be a 5.54 cap, meaning that you're getting more bang for your buck. That's what the broker is trying to tell you. So we know the relationship between the value. We'll just go over it really quickly. So the value is equal to the NOI over the cap rate, and you can do just some quick algebra and just move it around. So now the NOI is equal to the cap rate times the value. So what we'll do is we'll look at these two different cap rates and we'll see the economic value difference between the two. And the first NOI that we come up with is $66,480. So the cap rate, based off of the fully renovated numbers, the broker's saying that we'll be able to generate $66,000 in NOI. But the T12 shows that we're only generating $60,360 currently. So that difference of $6,000 may not seem like a lot, but if we divide that $6,000, $6,120, by the, let's just say the market cap rate in this market is reasonably 5.5%, we divide that 6,000 by 5.5%, all of a sudden we come up with an economic value of $111,000, and that means you're overpaying for this property potentially by up to $111,000 if you were comfortable buying at a 5.5. It's called a true cap rate. So what we can do is look at this. Let's look at this in a little bit more realistic of a way. So this is what it would look like within MogulTool, and any spreadsheet or underwriting would look similarly. So this is what you have. You have your trailing 12 numbers, this is the profit and loss. And let's just say that we have a different scenario here. Let's say that we have a scenario where the marketed the purchase price is being marketed at $1.871 million, and it's being marketed at an 8 cap. Let's just say it's an 8 cap market. So we go to, let's just start with the broker's numbers. So the broker is telling you that, hey, here's all our income, here's all our expenses that we think that this property can hit. we think that this property can generate $149,750 in NOI. Well, at this purchase price, this $1.87 million, that is an 8 cap. That is indeed an 8 cap. If you were to divide 1.871 by, or actually multiply it by 8%, this is the number that you'd come up with. Now, we know that the broker's job is to sell the property and to make it look more appealing than it actually is. So we would also look at the T12, the trailing 12 numbers. We look at the profit and loss and see how the property's actually performing. Now, after we look at the income, after we put in the expenses, we come up with an NOI of $80,500. Now, based off the marketed 8 cap, it turns out that the property should only be worth or be selling and trading at $1 million, which is quite a difference between $1 million and $1.871 million, and the actual true cap rate is a 4.3%. Now, there's a pretty significant disparity here, and in the real world, we would want to dive into that disparity and kind of figure out where the real value of the property lies. You would do that through maybe looking at a property manager's numbers, having them submit a number, and then kind of figuring out what your version of the truth is, putting it into the offer model, and then it'll give you an idea of, based off of the marketed cap rate, what a fair market value offer would be. So hopefully that was a helpful video and a quick little discussion about NOIs, cap rates. If you have any questions, leave them in the comments, and let me know if you have any other topics that you'd like us to cover. Have a great rest of your day.